Gonna take a look at the markets as we usually do. It's a bit quiet, but there's some action in some markets, and see if we can find out where that is. Before we start, I also always think to stress that trading financial markets, unfortunately, is high risk, and we may lose all our invested money. About 70% of people that trade Forex and CFDs lose money. And I think it's rather straightforward. A lot of people just trade with too much leverage. They bet too much on one individual trade, really. And people as well like to trade against the trend, which is a sure way of getting into trouble and being caught out one day. All right, let's begin with the easy stuff, which is the euro. I'll call it easy because it's not really going anywhere, so there's not too much to really do with this market. Now we have this little pitchfork that has been doing a rather good sort of job in explaining price action. Will definitely fail one day, but you know, would have loved to have drawn these lines. I think we could have drawn these already in October 18 last year, and that would have sort of explained the price action. So the general idea is that around that green line, people try to sell. So they try to sell. You see several of these situations. They sold here, here, maybe 4 times, 5. So you see a few of these occasions where they have sold. Sometimes the market would overshoot and almost hit that red line, and it's perfectly fine to short there as well, I think. And the general idea is, you can see, you sell here, goes down to the middle, sell here, goes down to the middle, sell here, goes down to the middle, and that's sort of what we're dealing with here. And we were, at least in hindsight, it looks like we did touch that level already on August 6th. And I guess if we move up to that level, and that level today is up here at 124, 112.40. So if we would go up there, I think maybe this would again act like some sort of a sell zone. If it doesn't stop here, might stop at this higher level, which is the red line up here at 13.75, somewhere on its way. Maybe it'll go halfway or something. 113, good psychological level. In general, though, as long as you're above this high, I'm gonna be bearish. Is there any issues with this one? Obviously, it all looks good and nice and neat here, but realistically, if you would have shorted here and you just go to the midpoint, so you would have put a stop loss up here, would have been a lot of one-to-ones here, as you can see, and that's a bit of an issue, at least for me. So you need to have a really high success rate. If you're a one-to-one, you need to be right more than 50% of the time to be making money at the end of, say, 10 trades, 100 trades. GBP versus the USD. Okay, what's going on here? So there's an old saying that I learned when I was working at the trading floor at an investment bank in Sweden. So I did my first 3 years at university, my bachelor's degree, and then I decided I'm going to go to London, because in London that's where sort of it's the Hollywood of finance, and that's where all the bright minds are, and I wanted to study in London. So I got myself a job at the fixed income and trading desk at Swedbank Markets in Gothenburg, where I'm from. And Swedbank is the biggest retail bank in Sweden. It's like your Barclays or something like that. And over there, the old guys, so the old timers told me, what doesn't go down will surely go up. And same thing, what doesn't go up will usually go down. It will try to test the other side of the range. And if you look at this market, it has been declining quite sharply. And if you just looked at this like this, and you felt no urgency to trade, which is really important when you comes down to trading, like realistically, the last major high is up here. That's a 125.19. So I think it would be prudent to say we maybe need a bit of a corrective move and then lower. And I think that's something that probably is going to start to come into people's minds soon, because we're not really trading much lower. It doesn't mean, though, that we should go long. The idea is more wait for the market to go up and then short sell. The problem with that theory, though, is that if you always do that, then you'll miss out. And then you never get that opportunity to get involved. So what I like to do, or what I have done for many years, is that I just push the trend defining level lower, 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 and right now it's here. And I've been saying that people are probably going to sell up here, and I'm going to insist on that people are probably going to sell from the first fib at 120.89. But my personal preference is to short sell at 112.50. I think that could potentially be slightly better option here in this market. So what can you do? Fortunately, trading is always about choosing your battles. We don't have to trade this market. There's other stuff to trade. And then I can only tell you what I would have done. And if it was me, I would just be bearish, but I would be bearish from 21.50. Stop loss up here, should risk about 60 pip, and then probably go lower, because I'm reckon if we trade above these highs soon, then people that did short here, they're gonna fill that short squeeze, and they're gonna push prices upwards. All right, this is dollar versus the Japanese yen. I did a little update to this one this morning. So I do these free webinars, but I also do webinars for clients only. And I said, and I've been saying yesterday as well, it's up here, probably the best time to sell. Because in hindsight, the market went down and up. They touched my first sell zone, then it went all the way up, and then all the way down. So it's like profit again as they left the sell zone. But then, with this in mind, when we already knew that it had been up here, I said maybe we could optimize this, and the general idea would be sell up here. No change here then. Crude oil prices, if you're trading West Texas, there's not much happening. It's just trading sideways. There's no point doing anything here. If you're trading Brent crude, then the outlook looks a bit different. So the trend is clearly bearish here. We clearly traded below these levels. We went down and then all the way up. And we didn't really trade, if I remember correctly, we did not trade above that trend funding level, which is up here. It was slightly lower before, but we bumped that up a bit. I think now realistically you can probably lower this a tiny bit like that. So we corrected up to the 61.8% correction level, and the way this is looking, we're now again trying to sort of recomplete that, and we could potentially move to 60, 60, but realistically I think, actually I'm just gonna leave it up here. I think realistically up here, people, if they can, if they're not already short, they will realistically try to sell, I think, here, up here. So I continue to be bearish. There's no change for this, despite what's going on with trade wars and whatnot. Many times with trade wars and stuff like that, it's easy to get caught up in the headlines. For some people, it works great. People that are trading very short term, they're just trading on these news. They just want to know, okay, what just happened, and then they try to get a few pips on the back of that. For that, for them, it's great. But sometimes what happens is that if you're selecting more longer term trader like I am, you see all this information, and then it's like you need to make a quick call. Especially if you have a few positions on, and then suddenly all start to go from say positive to negative. You need to make a quick decision. But many times, trading under when the market is moving, and under sort of when you need to take these rash or quick, not rash, but quick decisions, it actually, I think for the average person, it could definitely be a big problem. Obviously, I've been doing this for quite some years, so it's not like a big issue. But what I'm trying to say here is that many times it's always good to try to plan your trades when the market is quiet. That will be slightly before the London Open, so maybe around 7 a.m. Around that time, you would look at the markets and make a decision. Alternatively, what you do is that you look at by the end of the day, and then try to plan your trades like that. And then you just, you calculate your risk. If you're going to open 3-4 positions, then you need to make sure what happens if I get stopped out on all of them. How correlated are they? Because sometimes if they're all very correlated, you're going to lose on all or win on all. And if it turns bad, it turns bad quickly. So you plan all of that, and then you just work with your stops. And if they get stopped out, you sort of just move on to the next trade. A lot of people, what I need to say here, let me check here. You just need to work with the idea here that you stick with your stop losses and it's proven otherwise. Sometimes though, it's gonna be a good idea to get out of everything. There are certain occasions, like it shouldn't be more than maybe once or twice a year, at least that I done that you sort of hit the panic button and say, oh wow, I'm getting out here before everything just goes really bad. It's usually on the back of one of those Trump tweets. But obviously trying to avoid that as much as possible, because what's quite interesting is that even Trump's tweet and comments and actions from the US government doesn't necessarily influence the markets that much. And a good example of that is, for example, crude oil prices, where they tried to get a price down. It went down, but obviously not. It went up. I remember crude oil, I think there were complaints about price being too high here in February 2019 by President Trump. And then it went up, still up to 65. So that was a gain of about 20% or something like that. And then it tumbled. In fact, it was already here, up here, I think, complaining. Which makes sense here. I mean, I understand. You know, you want to keep, there's nothing wrong wanting keeping crude oil prices low. Crude oil prices high. Crude oil prices, it's like a tax. You know, who wants to pay more for energy? I'm paying a lot for energy already. I agree. Crude oil prices should be low. If everybody should have sort of their fair share. Now, let's move along here. This is the price of gold, and gold is, you know, is bullish about 13.99, and the fib from the very low to the very high gives you these fibs. And my preference is that 50 level. I might be totally wrong, and if this stabilizes into a nice little rectangle or some other interesting pattern, I might work with that, say bullish breakout, or maybe buying at dips here. But right now I don't feel no rush. Sometimes you just need to understand, or I need to remind myself, and it's not reminding myself, I kind of know it's rather good, but sometimes the market just runs away from you. And unless you have a good system that can take advantage, sort of get involved in a mature trend like this, then there's not too much to do about it. At the end of the day, risk-reward ratio, following the trend, not risking too much money, you stick with that, and the profits come by themselves. But every time we sort of try to chase a move that we missed out, buy at the highs, buy at the lows, and then, buy at the wrong levels, really, then you're gonna get in trouble. So here, what's the game plan? Okay, 50% trading sideways, maybe buying at the lower levels potentially here, but again, there's no rush. German DAX. So German DAX here traded all the way down. Unfortunately, did trade below the low, and but it didn't necessarily trigger a massive sell-off. I would say, at least in the short term. This is probably going to go up the way it looks like now to 11,600, maybe 11,700, and then we'll see what happens. It's rather difficult to say what's going to happen. As you know, the German economy contracted. The second quarter GDP numbers were showed a contraction. It's not looking that good, but as I said before, again, you know, everybody, given the way the market has been looking like for the last say 10, 11 years, which is after the end of that the global recession or financial crisis, if you remember that, you know, people haven't necessarily been having income growth, right? Doesn't mean that you're in a recession and cannot buy stuff, and that's really where the German economy is right now. Like German GDP, you know, if you lose 0.1% in GDP, it's not a big deal, but it's definitely not growing. I think that's the issue. To have growing stock markets, you do have, however, need to have a growing economy. And they're not having that right now. So what can we say about this? Is it gonna soar all the way up? Probably not at least right now. Can we go up a little bit? Yes. Can it tumble if things turn worse? Yes. So for now, I'm gonna be bullish like that. This is the S&P. The S&P is trading sideways for now, and obviously the bears are wondering what's going on, because bears have been bears since so many years, and we're still not that far away from an all-time high. In fact, we're just 5.5% away from an all-time high. Bond markets obviously tumbled, and definitely warning about significant decline in inflation or like a recession. And who's gonna be right? Well, usually it's the bond market. So maybe it will go down eventually. It's just that it can take quite a long time. Here in the short term, the price is trading sideways between 27.29 and 30.24, and there's not too much to do here really. Um, if you're on the bullish side, you can try to buy from the lows. If you're on bearish, you can try to sell at highs. I'm sorry, there's not too much more I can say about this. The alternative would be break here, that would definitely be bearish, or bullish here, that would definitely be bullish. Um, if you look at the bond markets, as I just mentioned, this is the yield on the 10-year government bond yield, and you can see how it just plummeted. So it was up here at 3.22, and now it's at 1.58. This again indicates low inflation, lower interest rates for central banks, and lower economic growth. The thing is this though, is that what happens here is that before, if you want to, this is the benchmark rate, right? So the idea here in general is that this is the benchmark. So maybe if you're a corporate, I don't think we can get corporate bond yields here, but if you're a corporate want to borrow money, then you need to pay maybe something on top of what the government is paying, right? The benefit of the government is that they will always be able to pay back because they can always just raise taxes, and it will live forever, the government. So it might not pay you this year, but it will pay you within 100 years, right? So this is sort of the safe benchmark. But what happens here when this goes down, it also lowers the price of borrowing on the corporate bond market. And now this has been cut with, I think, almost 50%, right? 50%, 51%. So 51%. So it's cheaper now for corporations to borrow money, and that makes it easier to finance their interest rate costs and that should help the bottom line of some stocks. At the same time, it might also it will definitely make it easier for consumers that are buying student loan, car loans, credit cards, and so on. Okay, we got a question here. What's my opinion on the Aussie stock market? Yes. So let's take a look at that. This is Ronnie that is asking. So the Aussie stock market was doing rather good for quite some time. So this is the Australian stock market. This is just your weekly chart. A nice little uptrend here, and now you're having a correction. Just quickly putting fibs on the low to the high here. You can see that you have various levels here, and if you look at it from a 6-hour chart, you had the break here, and then it went all the way up, tested that support, turned to resistance, and the trend is firmly bearish right now in the short term. I don't have a very strong view here. It's usually not the best to short these markets that are very elevated. What you could do is you can try to find a market that is already weak and trade that maybe. But here, maybe from 6,500, I wouldn't short this myself, but I'm reckon that maybe from here, people will start to sell like that. Maybe target 600, 6,300. And then we'll see maybe how much lower we go. Historically, in the past, this is the market that has some significant declines. Like this is a decline of 15%. This is a decline of 6.73%. So what's happening here in Australia in particular is that they're cutting interest rates. And I guess that could explain why this is moving upwards. Same time, if you look at something like the Hong Kong stock market, the Hong Kong stock market is rather different, right? So the Hong Kong stock market is also bullish, but it's just challenging this major low here. It's not necessarily ready to fall off a cliff, but if it does stick out this level, it could probably go a little bit lower. Then you have the Shanghai composite. Let's take a look at that one. This one's actually rather stable, not that bad. Here's definitely short-term bearish, but this high here. But if you look at it from a bigger picture perspective, it's actually not going too far, or too. It's not doing that bad. I think what these markets are telling us. You got the FTSE A50 as well. What these markets are telling us a bit is that we're not really out of the woods with the trade war, and I think everybody knows that. But it's not as bad as before. Like last year at least, you had very strong bullish uptrend and then strong decline. And if anything, it tells you that things are going to moderate and maybe sideways. Let's look at the Taiwan stock market. This is the Taiwanese stock market. And it's interesting. This actually had a nice little break here. Literally everything had a break in October, to be really, if you remember. Also overall bullish, just above major support. To turn really bullish, we need to take out that high here. And you have that uptrend like that. So if anything, I think maybe people will try to buy down here. Lower levels, I would argue. Why is the bund on what's the bund on the up for so long? What happens with the German bund, which is the German government bond yield, the 10-year one, is that it's considered to be safe haven. It's sort of the safest thing you can have in Europe, and I think people are trading it because obviously I wouldn't buy nothing that is negative. It's negative 0.65 basis points. So that there's what's quite interesting here is that it's the safest we have. So when you have a situation where people are afraid what's happening in Italy, Spain, UK, places like that, people will go into the German bond market because they think it has a high credit worthiness. The idea is you can park your money there. And obviously right now, if you park your money here, you'll lose 65 basis points per year. But what's also interesting is that the way the central bank is probably going to cut rates, you will be losing money anyway. So people are sort of trying maybe going to park some of their money in government bond yields before you get that hit from the ECB. What's quite interesting here is how negative this is. So what this is supposed to be the average interest rate over the next 10 years. That's right. This is supposed to be the average, because here the idea is that you get compensated for inflation as well. So imagine that average interest rates negative 65 basis points over the next few years. I said what's quite interesting in general here is if I was the German government, and I would just borrow money now, because as long as you do it into proper investments, right? Things are going to increase productivity of the country. I would do that. UK as well. I think UK government bond, the gilts is what they call them here. This is the actual. Let's see if I can find. This is the actual bond price. US government bond yield. Yeah, even this one is very negative. 0.44. Bond yields and bonds in general has been one of the few things that actually trended really, really well. I'm a strong believer that every asset class has like a very strong trend that is rather sort of easy to work out and sort of try to follow where it just goes. And in government bond yields, you have had a few opportunities to get involved. Biggest challenge though from the retail perspective is that right now the way things are working out is that because of the ESMA regulations, um, the margin requirement on trading government bonds have increased quite significantly. And the biggest problem, and the problem is that just to put just to get any sort of return on bonds, you need to have a significant position. So it's quite interesting. I saw some accounts, like if you say you want to have, I don't remember exactly the numbers on top of my head, but say you want to have a 500 pound risk. Just to, so the risk would be entry versus stop loss, right? So if you want to have 500 pound risk, I think the margin requirement just to open something like that was a few thousand. It wasn't like 1,000, 2,000. I think it was like 5 to 6,000, if not 10,000 pounds, just to have that small risk, which is obviously someone somewhere over at the European regulator didn't really properly think that through. It's a bit like the currency market to some extent, even though it's not as bad. Like the margin requirement here, you can still have 30 times leverage, which is really, really good. So you can still open a position, I'd say a 1 mini lot, well, about $370 or 350 euros or something like that, which is still good. But in the bond market, you need to open up like a lot or several lots to get the same sort of monetary return on loss. Okay, we're gonna wrap things up. I hope you guys have a good day. As always, guys, don't forget to hit that like button. It's very straightforward. Just click down here. Have a good day, guys. Ronnie, thanks so much for your questions. And I'll see you guys, and hopefully you, Ronnie, as well tomorrow. Have a good day. Bye-bye.